Okay, so hi there. Chapter 8 looks at a range of a couple of standards. It just kind of puts a few standards in the chapter together to look at that they could examine you on. So let's just go through them and see what they have, what we have here. At least you'd have come across one of them, though I think the one on inventory. This might be new. So this is the first standard we're dealing with here. How we deal with accounting policies, estimates, and prior period errors. Let's look at that. So fundamentally, every business must decide how they wish to classify, deal with certain balances on a consistent basis. So, for example, it might not look like a policy, but even the very idea that where will we put depreciation? Will we put it within cost of sales, or we will leave it within expenses? This is a policy because, if you like, you can't put it in cost of sales in one year and then put it in expenses in the other, because of course here you would see straight away a tampering, if you like, with the margins, won't we? Gross profit margins and net, and if you like, net profit margins and operating profit margins. So an organization has to kind of decide which to work with. Another policy is really the recognition of inventory. So are we going with a FIFO? Are we going to go with an AFCO? You can't choose one year to go with FIFO and then the next to go with AFCO, unless, of course, if this becomes more relevant, then you must stick with whatever it is you've just newly chosen. And that's kind of the principle there. So pretty much accounting policies are these principles, bases, or conventions, as I say, and that you have decided to work with in your financial statements. So it says IAS 8 requires an entity to select and apply appropriate accounting policies complying with the IFRS standards and interpretations to ensure that this information is, of course, relevant and reliable. So if you're going to go with, for example, so another example is, are we going to go with cost? Are we going to go with revaluation in terms of measuring our non-current assets? So if you're going to go with one, you have to stick with that, and it must mean that this is relevant to the nature of the asset we're talking about, because fundamentally all assets are nothing else but present values of future economic benefits. And if you have an asset that fluctuates a lot or is very actively sought after in the market and there's a lot of activity, it might make sense, of course, to go with the revaluation method. But if you have an asset that it's unlikely to be sold, it's not an asset that's actively sold in the market, so it's a factory, well, then it makes perfect sense to leave it at cost. So it's just reacting to the nature of the cash flows, really and truly. So this is what I was saying, reliable, and it must faithfully, as much as possible, closely as possible, faithfully represent the results and the financial position of the entity. The general rule is that accounting policies, like I said earlier on, are normally kept the same from period to period to ensure comparability of financial statements over time. IAS 8 requires accounting policies exactly to be only changed, one, if it is required by an IFRS. So, for example, one good example here is that when I was studying borrowing costs, typically borrowing costs, businesses had the option of either expensing them or capitalizing them, and the standard now requires you to capitalize them. So if the standard says change, if you were once expensing, well, now you have to capitalize. And of course, if what you're going to do will result in a reliable and more relevant presentation of events, then please, then it makes sense. So these are some examples here. This is the one like the borrowing costs where you have an expense. Well, it might be the other way. It's now recognized rather than an asset, depending on the standards. There are lots of standards. We just don't get a chance to look at all of them. It could have been the other way around. The one I gave you about depreciation now being included in cost of sales. And we're going to choosing to go with replacement cost rather than historical cost. This is another option. Yes, so one of the key things here is that if you now choose, once you decide to change your policy, you are now obliged to go backwards retrospectively and change all the whatever it is you've just changed according to the new policy, so that we can maintain consistency. Really, that's the point here. That's the fundamental point. Now, of course, it is really a matter of judgment and materiality. And if it is impossible, if you like, and if it's not material, then okay, then it's okay. Then the changes should just be made prospectively. But really and truly, unless it is impractical to do so, you should go backwards and change things retrospectively. Okay, right. The next thing I'm going to talk about is what's referred to as accounting estimates. And your classic accounting estimate, when I was studying depreciation policy, exactly, it was called depreciation policy. Depreciation was policy. But I think conceptually, the more you look at it, it really is irrelevant whether you use a reducing balance method or a straight line method. These were estimates always in the first place, if you like, right? And you would do a bit of an adjustment at the year end or test for reasonableness just to see how far off the depreciation that's been put there is from the calculations that have been made. So really, depreciation is your classic example here of an accounting estimate where we just it doesn't really matter which method you go between, but again, you want these methods to line up, if you like, and align with the nature of the asset being discussed. So typically most figures, and it could be a provision, it doesn't really matter. The key point here is that there's some estimation, and what we're doing every year on year is exercising judgment, if you like, to make the best decision. So we may review at a later date estimates as a result of the availability of new information, more experience, and subsequent developments. So key point is the changes are prospective, if you like, and of course, full disclosures on what these changes are. But the key point is that we're only ever going forward. So this is only perspective. So for some of examples, you might have the useful life changing. Well, I mean, of course, again, the depreciation figure itself is changing really due to it. Depreciation is a function, isn't it, typically of useful life, the residual value, and the method of depreciation. Again, like I said, you might have warranty provisions, whatever it is, all prospective based on new information. And so that's the second one. So key point here is accounting estimates are always prospective. Okay, right. And the third one in that batch is to do with errors in the past. And so errors might just really be arithmetic. There might not be fraud involved. They might just be genuine errors and mistakes made, if you like, brought forward from the past. So prior period errors are omissions and misstatements in the financial statements for one or more prior periods arising from a failure to use information that was available for authorized issue. And you would reasonably have thought, you should have found that out, but there was a mistake. You missed it. No problem. What they're saying here, like I said, they could be just math errors, maybe mistakes in applying the right accounting policies, and of course, potentially fraud. So when you find errors, of course, you need to correct them, but you need to go back. If there are any prior periods, basically are going back and putting what it should be, and therefore the opening balances, of course, will now change, won't they? Because if you correct any error, technically the closing balance of that year will now become the opening balance of our year, and then we will see that change. And so we should go back retrospectively and fix these errors. So restating the comparative figures presented. Again, of course, there's the question of materiality, and if it is almost impossible, or if it is not material, then you may disclose clearly what this error was, if you like, to give your users a good understanding of what's taking place. The key point is, once you're going to go correct, you will see that, of course, this means that you will have changes to what's going on at the beginning of the opening balances of the current year, the previous year, and at the beginning of the previous year, depending on how far back you're going with the error. Yes, and that's really all those changes must be made, if you like, and adjusted. Okay, great stuff. I think it's a good place to end. So what we've just done is looked at IAS 8 and looked, of course, at accounting policies, accounting estimates, and prior period errors. Okay, great stuff. I'll see you in the next video.